Hi, everyone. This is Jason Bjark of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. I'd like to welcome back returning guest Eric Sprott. He was last on in 2014. Thank you for joining us again, Eric.
Jason, my pleasure. Happy to be here.
Now, Eric, we're seeing a lot of interesting things going on with interest rates and financial repression. Can rates be permanently manipulated lower, in your opinion?
Well, I think, Jason, that it looks like anything can be manipulated these days, certainly on an hour-to-hour and minute-to-minute basis. We've seen the examples of this trader in his parents' London basement affecting the S&P, which is a bit of an irony. He had all of $5 million, yet he forced the S&P down. And we've had two traders charged with manipulating or spoofing the gold market just last week. Everything. And where was it? I read that somebody, I think in the States, was so upset with Deutsche Bank because they're basically manipulating everything. So I suspect that, it's almost within the bank trader's mandate to maximize profit. And if it means, messing around with the market by putting in large unintended to be traded orders and forcing things either up or down, that's done on a regular basis. So yes, I think that all those things are manipulated. And of course, one of the things I think we see all the time is these squeezes that take place where, everybody gets long the U.S. dollar and then they get squeezed out of the U.S. dollar. And everybody's short oil, they get squeezed out of oil. And it just goes on and on and on. So I see it regularly in the gold and silver markets where, an option expiry, the strangest things always happen to make the options expire worthless and have the commercials end up sweeping the table every 3 months or every month for that matter. You see it all the time, and there's no doubt that it's very hard to predict on a day-to-day basis or even 1 week to 1 month what should happen in a paper market where guys with deep pockets in the very short term can affect the price. So yes, I would certainly conclude that markets are manipulated in pretty well every market.
Yeah, and these large central bankers in developed world countries, whether it's the U.S. or Japan, it just seems, they can basically create money out of thin air, these digital dollars or digital yen or digital euros, and you have hedge fund managers doing the carry trade. It seems that the goal of financial repression is to try to take the yield curve down to zero, but we're in uncharted territory where, interest rates have never been suppressed this low for this long.
Well, there's no doubt that's overt manipulation, though, right? Where we know that they just go in and buy the bonds and drive yields down. And of course, they drive yields down because they have this assumption that if you get yields low enough, it will cause economic activity. And to a great extent, that's true because the marginal home buyer with a 1% less mortgage becomes a real home buyer, and the marginal car buyer with zero rate financing who shouldn't be able to buy a car can buy a car. So that has had a very sustaining, and I use the word sustaining very appropriately, effect on the economy, such that we haven't seen the correction in the economy that one might have predicted starting with the NASDAQ crash in 2000, the financial crisis in 07, 08, and it's been held together by the central planners trying to come up with ways to keep the consumer buying. And of course, low interest rates has been a huge factor in doing that because we have all these subprime auto loans and then the U.S. government stepped back essentially into the housing market by making the down payments less, and of course the rates are lower. So we have somewhat of a fictitious support to the economy because when you revert to normal, if that ever happens, then of course everyone gets knocked out of the market the next time around. And it's the same old theory that, when an economy is growing by issuing debt, the minute no one wants the debt, the growth stops. Or when the debt has to retract because it's got to be paid off. So I think so far with taking these rates down, in fact going to negative interest rates, it's sustained the economy on this false premise that everything's well. And I've always argued that everything is not well, that the economic data is lousy, that the chances of some kind of recovery are well near nigh. And I would sort of point to the second quarter U.S. GDP, which is 0.2%, and based on the latest trade data, it looks like that might even be revised to negative. Consumer confidence is falling and is likely to fall because a lot of times it follows the gasoline price. The gasoline price has shot up, I gather, 30 cents a gallon in the last 2 weeks. So our next consumer confidence indexes are going to point to some problems they had. Not that we don't have problems already. We do have problems, and I think the biggest problem is the understated impact of Obamacare and the fact that everyone's biggest expense, which now seems to be health care, their premiums go up in double digits, their deductibles go up, and their copays go up. So everyone's looking at this mountain of potential problems, and it, of course, negatively affects discretionary spending. So I've never believed in the economic recovery based on the kind of monetary policies that the central planners have used, and I think it's kind of playing out that way, that if we ever got back to normal, my goodness, if we ever had 5% interest rates or even 3% interest rates, we would see how quickly things would crumble.
Yeah, I agree. I don't think we've had much of a recovery. The only major sector that was creating a lot of high-paying full-time jobs in the United States, besides technology, was the shale oil boom, and it's been busting lately.
For sure. And not only do they lose jobs, but they lose well-paid jobs. You know, an oil worker might be paid, oh my goodness, he might be paid 5 times what a minimum wage earner would make. So, you know, you lose one oil job, I mean, you got 5 jobs on the other side, that personal income stays steady. And unfortunately, from the government's perspective, those 5 low-paying jobs, they don't even pay taxes. And the guy who had the high-paying job was paying a lot of taxes. Now he's out of there. So, and I do believe that, you know, every time we look at these new jobs numbers, we, of course, totally take out of the equation that so many of these jobs are low-paying jobs, and we lose the high-paying jobs, and we look at some absolute number that we created 259,000 jobs or something. And, of course, a lot of those are where the guy used to work 40 hours a week in an establishment, then he had to get cut back to 29 and a half so the employer wouldn't pay the employee benefits, including health care. And so that guy's got to go get another job, another temporary job. Well, a temporary job counts as much as a permanent job in the job numbers. So there was a natural bias for it looked like there were jobs being created when in reality everyone's income was stagnant. So we have to be very careful with jobs numbers these days.
Yeah, I think the real economy, Eric, is in worsening stagflation here in the United States. But you know, there's so much statistical garbage with the formulas and the way they're changed, whether they're GDP, CPI, unemployment. It's all, you know, there's no real honesty coming out of these numbers for the most part. Maybe a little bit here or there with a few things, but most of it is garbage in, garbage out. Why don't you think Keynesians, the people, the central planners, see much higher asset prices as evidence of inflation?
Because, as you said, they don't want to see it. You know, they want people to believe it. I read an article today about, you know, the Fed forecasting, and every year we start the year with, you know, we're going to have 3% growth, as we started this year with 3% growth, and last year with 3%, and the previous year with 3%. And we get to the end of the year, and there's no growth. And somebody's critical, well, why do they keep making these estimates? Well, they keep making these estimates so they keep everybody in a positive tone. You're not going to come out in December and say we expect GDP to be up 0.2% in the first quarter. That's not going to carry the day. So there is a constant understanding by the powers that be that we are in a very tenuous financial position here, that the banks are still massively over-levered. They got all these derivatives. We can't let this thing unwind, and we will do everything in our power to keep it from unwinding. And as I was coming to work today, I'm reading about all these insurance companies that supposedly make these great earnings. Well, of course, the banks and the insurance companies have been the huge beneficiary of declining interest rates because their whole portfolio on the asset side is interest rate related, and it goes up in value. What happens when that reverses, which we're seeing a little bit of that today and these last few weeks? Then all of a sudden, instead of making money on your assets, you're losing money on your assets, and you're levered, and your derivatives have a huge problem. So the powers that be, the central bankers for sure, know all about this and are constantly fighting it on a day-to-day basis. And whether it's, you know, the day that the U.S. QE started or stopped, Japan's QE started. Now, I find that pretty ironic that it wasn't one day later we had another guy in the market buying bonds, because it's a universal bond market, right? And I was actually suspecting the Japanese might pair their bond buying as the Europeans started their bond buying. Now that hasn't happened yet, but we buy more bonds than we've ever bought today on a world basis, and it's just to try to keep rates down so that people can continue to consume beyond their means.
And Ben Bernanke actually, before he became Fed chairman, actually wrote an academic paper about, currency wars and beggar thy neighbor. And he said that if everyone prints at the same time, then it's not a competitive devaluation. So maybe there is a lot of coordinated central bank action between the U.S. and Japan. I mean, after all, the U.S. did come in there after World War II and, rebuild Japan and rebuild Europe. So there probably is good evidence of coordinated action. My next question has to do with the SDR. Do you think China wants the SDR, or do you think that they're planning on pulling it apart, joining getting more power in the IMF from the inside after they maybe get into the SDR basket?
I think there's two questions there, and one is do they want the yuan to be part of the SDR? Yes, I believe they do. That's been quite obvious, right? They want it to be part of the SDR, which would boost their currency. I think the bigger part of the question you're asking is, do they want the yuan to be in essence, the world's reserve currency? And I'm sure they want that too. Of course, that's a much bigger issue, and we've seen them take tentative steps with their AIIB bank and the various comments that they make from time to time about ending the U.S. dollar's reserve currency status. So, yes, I think that China has as an aim to try to create that. I'm always a little suspect of China because China's growth in loans has just been beyond belief. I mean, there's an economy, I don't know what their economy is today. Let's say it's a $6 trillion economy, and they have bank loans of $2 trillion a year. Well, I mean, that $2 trillion goes into something productive, I presume, and if all of a sudden that wave of lending gets too high, and I don't know that these numbers are exact, but I would bet in the last 10 years that China's lending, total loans outstanding, went from something like $2 trillion to $27 trillion. Now, that's a lot of loans to be paid off from a $6 trillion economy. And we've seen some very weird things happening in China lately with their market going nuts and all these people opening up accounts. And as you probably noticed this week, it's had a pretty good correction down. I think it was 8.3% in the last 3 days or so. And there's no doubt that they created a bubble, and they may even come in and do some quantitative easing, although it's not as necessary there because the banks would almost lend money willy-nilly over there, so you don't need quantitative easing. You have a banking system that is just incredibly levered, and I think where the lending standards aren't up to par. So, yeah, but yes,
the banks are ordered.
Yeah, no, of course, they're run by the government in essence, right?
Yeah.
That is the government. So.
Yeah, it's hardcore. It's hardcore central planning in a lot of aspects over there. I mean, there's obviously some capitalism too, but it's a complicated disaster because there's just so many stimulus. There was an enormous stimulus package after 2009. It's I guess trillions in central planning. There's just so much misallocated capital over there. Like look at how much oversupply I think in the copper market there's been in iron ore and steel because of China doing all these projects.
Sure, and then we're seeing now the effects of. When your customers can't afford to buy, your economy goes down. And the customers, of course, of China are the U.S., the EU, Japan, whatever, and all the developing countries, whether it's Brazil or Argentina. And, of course, all these countries seem to have their own problems, and their ability to consume those products being made in China is declining now. So we've seen some huge cuts in exports out of China, and every time we seem to be getting a new index on China, some kind of PMI index or so on, they're all weakening here, and it looks like they may be on the verge of some kind of recession.
Now, we have a listener question from Rob Perry. We actually have a lot of listener questions submitted for the interview. Got a lot of questions sent in from my listeners.
Sure.
Given silver's use as a commodity in the manufacturing sector, how much do you think a slowdown in China's manufacturing will impact inventories and silver demand in China?
Sure. Well, there's no doubt that silver is very much industrial. I think it's probably 50% of the use if you exclude jewelry from that equation. And yes, silver can be impacted by a slowdown in various gross production indices. However, we have seen everywhere in the world this move towards solar. And you know that the solar projections for China are just absolutely huge. We saw Elon Musk come out and say, well, he wants to have a storage battery in every home. And of course, a storage battery assumes you got to have the solar panels in every home. And we have lots of use there. We have lots of use in all the high-tech gadgets, which, of course, people spend more and more money on. So I don't see it as being as dramatic today as it would have been before, but no doubt some parts of that will have some weakness. I think that what we should look at the other side is if my feeling as to where the economy is going plays out, you get problems in the banking system. And the minute you get problems in the banking system, people start getting concerned about having their money in a bank. And if you take your money out of a bank, you don't have many places to put it where you can hold value. And we're looking at a situation in Greece here where we may wake up, some Monday morning and find out that all the Greek bank deposits are taking a haircut. And just like happened in Cyprus, you say, well, why didn't the people buy gold and silver? And, of course, that amount of buying would overwhelm any decline in industrial consumption. But it's something that will affect the basic supply demand data on silver, but there's so little silver around. I mean, if some big investor wanted to buy $5 billion of silver, I think it'd be all over here. It would just scoop up everything that was available to be purchased. So it's a very small market. If something happens in the financial arena that makes people jittery, and we are seeing it every day now, particularly as you call today, and we watch these German bonds flying up to higher yields. We see the peripheral countries' bond yields skyrocketing. We look at what's going on in Greece. We look at what's going on with the currencies. I mean, where your currencies can fall by 20 and 30% in a year. It makes the reasons for owning these monetary commodities very much more appropriate. And yes, they haven't really rallied, although silver has rallied this year. Gold's rallied very, very little. But between the negative bank deposits and the fact that you have your money at risk in a commercial bank that's massively over-levered, and the possibility of a bail-in, I mean, you would think there would be this flow if people were thinking into precious metals. So that's what I think should carry the day.
Yeah, the reality of supply and demand, Eric, when I look at the market and not the paper price, I see mining problems. I see the copper miners, which produce an enormous amount of byproduct for gold and silver. I see the copper price getting absolutely killed recently. And, those that once those copper hedges come off, a lot of gold and silver byproduct could eventually come offline. I see a lot of primary gold and silver miners, struggling just to keep their heads above water. You're in Toronto, one of the mining finance mining capitals of the world. And I don't think there's debt and equity available for most miners right now. Do you think there's more cost to cut for these primary gold and silver miners without shutting down the mines, or do you think they're running out of ideas for ways to cut costs without shutting down the mines?
Well, I think they're paying way more attention to it today than they were before because the price is so meager that it's hard to break even. There's probably more to be done. They benefited certainly by the price of energy going down. I don't know if it looks like energy is going back up again. If you ask me, I always think of any commodity when it moves by 20% that things have changed. I look at the price of oil going from 44 to 61, and that's way beyond 20% here. So I think that the fundamentals for oil have probably changed, so therefore that cost is going up. But I can assure you, and I'm on the board of a gold company, and we're always looking for things where we can do it more efficiently. But there's not a lot of room to cut. I mean, I can't imagine that you'd even save more than, $25 to $50 an ounce in terms of production costs. And of course, the low-hanging fruit has already been harvested here, and it gets a little tougher as time goes on. And to that point, I mean, we see lots of major gold companies where their gold production is not going up. I'm just reading the Gold Fields report today where their production, I think, was down 10% in the first quarter. We might have a miner strike in South Africa, which would affect the supply. Most mines are high-grading and you can only high grade so long before you run out of high grade ore, and then you naturally have to go with lower grade ore. And you could see some of these companies losing 10 and 20% of their production as they've left the high grade areas and they have to go to the more normal grade or below mine grade areas. So there's a lot of pressure on gold supply, particularly as you look forward here. There's been lots of great work done by, I think it's Gold Corp and others, who basically said, we've seen peak exploration here, and if you see peak exploration probably 2 or 3 years ago, ultimately you're not going to find new deposits. We've seen lots of small and middle income producers who can't get financing and therefore have to shelve projects. We've seen lots of projects shelved here. So things that you thought were going to come online that would have helped the supply aren't likely to happen. So on a longer term basis, the supply-demand situation looks great in my mind, because one can easily foresee if prices stay here that supply is going to have to come down.
Yeah, I looked at the feasibility studies, Eric, for a lot of these gold and silver mines that were brought online in 2009 and later, and most of them needed much higher metals prices to be economic, and maybe they've been able to cut some of the costs, but I don't think they've been able to cut the costs that we're at now. I don't think they envisioned silver, getting back down to these levels and staying here for a while. So, but we are seeing evidence, I guess, that we are in a bottoming process, and the cyclical bear market, this, paper manipulated cyclical bear market, is going to be over soon, I think.
Well, to the point of what producers do, I can tell you one other thing they're doing, Jason. I think I've read that various companies who might have used a 12% annual return for a project are upping that return. So therefore less and less projects meet that profile because the expected return is higher. And quite frankly, I would never start a mine and only want to see a 12% return. That's the minimal return for the risk that's involved in opening up a gold mine and all the things that can happen to you before and after opening up the gold mine. It's just not an appropriate return, and I think that might continue to rise, and as it continues to rise, it makes more and more projects marginal and uneconomic. So I think that will continue to play out here.
Yeah, I think there's only a handful, maybe 4 primary silver miners, and most of them are really tiny, that are actually profitable all in at these prices. So, even the larger ones, they've cut costs, like Pan American Silver and First Majestic. They've done a good job cutting costs, but they're still mostly just treading water. They're not making a good margin at these prices.
Yeah, and I think the demand for silver has been strong. I just read our Royal Canadian Mint announced their numbers, and there's several silver sales. I think we're 29 million ounces, up from 28 million ounces last year, even though we all look and say, nobody likes silver. Well, I find it stunning, and I got to do a calculation in my mind right now, and they sold 40 times more silver than gold, and the U.S. Mint sells 100 times more silver than gold to investors based on coin sales. And yet we produce in the world something like 8 times more silver than gold. Well, how can people consume, in numismatics, how can you consume 100 times more when there's only 8 times as much, and there's less silver available for investing than there is gold available for investing? Because as we've talked about, a lot of silver is used for industrial production. So people, if you want to measure it by people's willingness to open up their pocketbooks and buy something, they're voting in favor of silver like 50 to 1. So it could be very exciting if everyone finally gets that fear, which we should have had for a long time, about their money in the bank, or not even the fear. How about just the fact they get no return on their money in the bank, let alone the fear part, and just decide that they should own something that's more likely to survive a crisis. And as you know, it's interesting, the people I listen to, the same people who in 2000 predicted problems, in 07 and 08 predicted problems, and they all, to a man, predict problems today in the economy. And we have new entrants, guys who weren't there last time, who are, very key guys that are kind of sounding the warning horn. And these people are not stupid. They know what's going on. And yes, the competition is the central planners who keep fighting to keep it together. And I've always liked to point out to people that ever since the Lehman crisis, I know that the outstanding orders are don't allow anybody to liquidate. No liquidations are allowed. And that's even true of banks, for example. What if they hadn't just forced the bank depositors to take a haircut in the Cypriot banks when they had to sell their assets? That would have started a liquidation. So we've never allowed a liquidation subsequent to Lehman because we saw what a liquidation can do. It affects all assets simultaneously. And it'll be interesting. I'm sure when the ECB has their day with Greece, essentially they just keep funding the Greek banks, okay? And of course that will prevent the liquidation, and then maybe they'll just walk in and say, well, we put in about 75 cents on the dollar into Greek banks, and now we want your depositors to take the real haircut, and they'll get bailed out, and no liquidation, right? They'll just run under the auspices of the ECB or the BIS or the IMF or something like that. But you start that liquidation process, and it can get out of control very, very quickly, as we saw with Lehman.
Yeah, I agree, and they're trying to do everything they can to prevent that because of the counterparty risk. They're trying to manipulate, boost all the asset prices higher in stocks, bonds, real estate. We see there's a lot of evidence here in the United States of government agencies subsidizing, trying to get people to instead of renting to the government agency will pay for the down payment for their house. The games are just ridiculous.
It's also prevalent in food stamp use, right? That's another way. Yeah. Just give them money. Look at the increase in food stamp use and the dollars expended in the last 10 years. It's incredible. Look at the handouts to students, which have been incredible. And they know what they're doing. They're just trying to keep it going. Like, give them the money. Even when we know they can't pay, we're going to give it to them anyway. And we know that the food stamp thing can't carry on forever, but what the hell? We got to do it because we got to have some semblance of economic stability here. So you see the signs of the central planners putting their forces into the economy and trying to keep things upright. And whether it's the student loans, the subprime auto loans, the lesser standards on mortgages, the food stamp program, these are all just meant, let's try to hold it in here, because if it breaks, we all know all hell's going to break loose, right? And it'll be way worse than it was in 07, 08.
Yeah, it's bread and circuses, just like the Roman Empire did. Keep people fed, keep people entertained with, sports and celebrity gossip and reality TV shows, and they won't notice a lot of the truth what's going on, or they'll place the blame somewhere else. I have so many more listener questions, but I'll ask one more before I let you go. Sprott is an investor in Bitgold. It looks very interesting to me. For listeners who are not familiar, it's a cryptocurrency type of technology that allows people to immediately redeem in physical gold, I guess cubes, small little gold cubes or bars. Can Bitgold be a permanent game changer in the way the modern world perceives gold as non-spendable money? Can this platform address gold's biggest criticism, Achilles heel, of no easy system of payment or medium of exchange?
Well, of course, we do have funds out there that allow gold redemption. Now, they don't allow it in minor amounts, so that Bitgold solves that in the sense that you want to redeem some small amount, you can. I think the most important thing is that you can transact with it, that you can have your credit card backed by Bitgold, and if you want to go buy a dress or a pair of shoes or whatever, you can use that card and find they'll take some gold away from you. And when I think of credit cards, I think of, if we all had a credit card in 2000, you had 10,000 cash balance and I had 10,000 gold balance, my balance on my credit card today, other things being equal, would be 40,000 because the price of gold went up by 4 times. The balance in your credit card is 10,000. And yes, in the last 4 years we've had a decline in the price of gold, but I think any rational person would think, hey, gold can go up here. Now I can have, in essence, a bank account that can go up in value rather than just stay steady state. In fact, think of a bank account. I mean, you earn no interest and you have to pay service fees. It's a wasting asset, quite frankly. So I think, yeah, Bitgold now that can be transaction oriented, gold backed in small amounts, and has the possibility of appreciating are 3 wonderful assets. And I find it very interesting. I'm going to be meeting with the people at Bitgold after this phone call, and I'll just get an update on how things are going.
Yeah, Bitgold sounds like, the old gold standard, how we had gold receipts and gold exchange certificates and silver certificates. It's kind of, that modern way with modern technology, how people can redeem immediately or they can store in vaults in different countries. So it sounds like a really good idea to me.
It'll be interesting. I'm going to wish them all the success in the world because I think it solves a major problem, as you pointed out, with currencies and credit cards and things like that.
Yeah, and exactly with the money in people's bank accounts now, with the possibility of bail-ins, bailouts, and people aren't getting any type of return really. Even in a savings account, I think they're only getting 1 or 2%, which is at an all-time low. There's just a lack of economic incentives, and I think that's why you're seeing so many older retirees who need income and yield. They're speculating in the stock market and so many other investments, and it's leading to very dangerous times down the road.
Absolutely, I couldn't agree more.
Well, Eric, I really enjoy our discussions. We have so many more listener questions, but your secretary told me I only have about 30 minutes. So I guess I'll have to have you on again in a couple months, and we'll ask more of those listener questions.
Well, Jason, I'll look forward to that. All the best.
I appreciate it, Eric.
Okay.
Take care.